Welcome back to another trade video. If you're new to the channel, I usually do weekly videos going over my trades for the week and talk about what trades I'm taking for the following week. This video is part of a new series where I talk about the option strategies that I use. And in this video, I'll be going over my top 5 tips for trading covered calls. I'm showing these in Robinhood, but these tips apply no matter what platform you use to trade. And before we get to that, don't forget to like and subscribe so you can stay up to date on all of my trades. One note about this video assumes that you have a general knowledge about what call and put options are and know that you can buy and sell options. If you don't, I recommend checking out some videos online before watching this, and I'll probably release a video in the future talking about the basics of options as well. I also have a video about how to trade covered calls in Thinkorswim, and you can check that out in the link below in the description. And now jumping into my top 5 tips for trading covered calls, I'm going to start off by doing a quick review of what a covered call is. Basically, a covered call is when you own the stock and then sell call options against it. And the key piece is that for every 100 shares of the stock that you own, you can sell one option contract against it. And now jumping into my first tip for selling covered calls. Tip number 1, pick stocks that you are okay with owning. So for example here, I have Apple pulled up. Some of my other favorites are Apple, AMD, TQQQ. I like to pick stocks that are safe and that I know will eventually recover if they do happen to crash. So you can see right here on the chart, Apple was at 134 and then it came back down to 111 and eventually recovered. So that's my first tip. Pick stocks that you are okay with owning and that you believe will recover in the long run, just in case the stock does crash when you buy the shares. Tip number 2 is pick a strike price that you would be okay with letting the stock get taken away from you at. So for example, if I was to buy 100 shares at the current price of Apple, that would be at $121. As part of a covered call, I would then sell an option at a higher price. So for example, let's say I sold at $130. If the price all of a sudden went above $130, I would have to be okay with getting those shares possibly taken away from me at $130 per share. And that's something you need to decide when picking your strike price. Are you okay with the shares being taken away and sold at that price that you are selling the call option? Now jumping to tip number 3, make sure you're selling the right contract. So in this case, imagine you've bought 100 shares of Apple for about $12,000, you place that, and now you want to sell the call option against it. You end up going to trade Apple options. The key things to remember for this tip are making sure that you click sell instead of buy, making sure you have this set on call, making sure you have the right expiration date picked, and then making sure that you pick the right strike price. So in this example, we just bought it at $121. Let's say we want to sell the $125. And then making sure that you set the right number of contracts. If you own 100 shares of the stock, making sure that you only sell one contract against it. If you own 200 shares, selling 2. And as that keeps going up, you can sell more option contracts. Now, the fourth tip is you want to ideally buy the stock when it is close to a support position. And what I mean by that is if you look at the 1-year price chart, you can see Apple has bounced off of kind of the right around the 105 to 110 mark. So right around here, again here, and then kind of again right about here. You can see that Apple kind of always bounces off this point. And one of the things I like to look for is I like to buy the stock when it is near one of these points because there's a higher chance that the stock bounces off of this point and then goes back higher. Obviously, past performance does not guarantee future success, but it kind of increases your chances of the price bouncing off that point again. So that's definitely something that I like to look for before jumping into a covered call. And the 5th tip that I have is don't be afraid to roll positions if you want to continue holding the stock. So in our example where we buy 100 shares of Apple at the current price of $121, and let's say we sell a call at about $130. If next week the price all of a sudden starts to go up pretty high, and let's say it gets up to $137, we can close out this contract and then sell another contract, for example, higher at $140 instead. The downside to rolling your position is that you have to buy back the contract for a higher price. So if I sold the contract and made $150, I might have to buy back the contract for, let's say, $500, and then I'd have to sell another contract above that to make back that money and continue holding the stock. What I like to do is when I'm holding a stock that I think will continue to grow for the long term, I will tend to roll my position so that I can keep that stock in my portfolio and continue to reap the benefits, even if I have to roll my call option. So to summarize, top 5 tips. Tip number 1, pick stocks that you are okay with owning. Tip number 2, pick a strike price that you would be okay with letting the stock get taken away from you at. Tip number 3, make sure you're selling the right contract. Tip number 4, ideally you want to buy the stock when it is close to a support position or support line. And tip number 5, don't be afraid to roll the position if you want to continue holding the stock. And those are my top 5 tips for covered calls. And again, those can be applied to any platform that you're using. As always, feel free to leave any questions or comments down below. And don't forget to like and subscribe. And I'll see you all in the next video.